You never know about the Russians. All right, Richard Fisher. He has been president of the Dallas Federal Reserve Bank for the past 10 years, one of the most interventionist periods in the history of the Federal Reserve. But he's one of those rare Fed officials who actually speaks his mind, frequently speaking out against his Fed activism or the activism of the Fed. And for that reason, he's going to be sorely missed by us when he resigns his position next month. But before he goes, he's been kind enough to give us time to talk about Fed strategy and where we and he actually goes from here in a Fox Business exclusive. Proud to welcome Richard Fisher, president of Dallas Fed.
Thank you, David.
It's when specifically do you leave the Fed?
Midnight of March 19th, and you said 10 years. Given what we've been through, you have to measure it in dog years. So let's say 70 years of service to
All right,
the
well, let's just talk about a little of what's happened, particularly since the financial crisis in 2008, 2009. The Fed has had a zero interest rate policy since 2009. I mean, it's 0.25% or 0 to 0.25. The portfolio of the Fed, this is what really worries a lot of people, has grown from $800 million, which is big enough, frankly, to $4.5 trillion. And then, of course, the Fed has gotten actively involved in bank regulation to a degree that I don't think we've seen since the Depression, really, the Great Depression.
Thanks to Dodd-Frank, by the way.
Thanks to Dodd-Frank.
Which we did not
as a part of that. No, but the Fed has been instrumental in making banks keep larger reserves, et cetera. The question is, has the Fed gone too far in trying to affect our economy and, in particular, financial markets?
Well, you know my answer to that is I felt we went too far, but let's put that in context. We went through this traumatic injury. The whole system failed. Now, whether we or anybody else was responsible for that, everything just collapsed, as you remember. And we did what central banks do. We stepped into the breach. We provided liquidity. Because remember, even the money market fund that failed, one of the great ones of all time, the first one established in the country, commercial paper, basic financial is ground to a halt. We stepped in. That was the right thing to do. That's what central banks do to save the economy. You don't have money moving through the economy, you can't conduct business no matter what you do.
But then it stayed there in the emergency mode. Exactly. And even now when we have unemployment rate way down, it's still an emergency mode.
We cut interest rates to zero. I didn't want to go that far, but it's a committee. I got outvoted. And then we started buying. Once you get to what's called a zero bound, the only way to put more money into the system is you have to buy things. And we're only allowed by virtue of our license given by the U.S. Congress, U.S. Treasuries or government agencies. So we bought U.S. Treasuries, mortgage-backed bonds issued by Sally, Freddie, and so on. Now, I felt at $2 trillion, excuse me. Got to get these numbers straight. At $2 trillion, we had gone far enough. But I was in a minority. We now have a portfolio of $4.7 trillion.
It's $4.7 trillion.
Very, very large portfolio.
All right, because I just looked at the last report. It looked like 4.5, but it's now 4.7.
Well, it'll vary, but the point is it's very large compared to where we were before.
Yeah.
Now, so what's happened? When we bought those bonds, we paid depository institutions for those institutions, for those bonds. They've taken that money, put it back on the books of the Federal Reserve banks in form of excess reserves. So roughly $2.5 trillion in excess reserves. What does that mean? That means it's excess money that banks or depository institutions have. They're waiting to lend to credit-worthy customers. And they become a little bit more lenient, but remember, they did go through this traumatic shock. And so we'll just have to watch to see how that money works into the system. My worry there, David, my personal worry, it's like a peat bog fire, okay? You don't see it. Our successors at the Fed, and this will take years to work its way back into the system, will have to control the velocity with which that goes back into the economy, because if it goes in too fast, then you have inflation.
Well, you think out of the box.
I don't worry about
one of the great
right
things,
now.
not only are you blunt in your description of things, but you also tend to think out of the box for solutions.
Right.
How do you get rid of $4.7 trillion? You clearly want to bring that number way down.
Right.
How do you do it? Do you let the bonds expire? Do you actively sell them, or what?
Very slowly would be the answer. Now, again, I didn't want to go that far, but we did. It is a committee. It's a thoughtful group of people. That's what was decided. So the real issue is the velocity of money in the economy. We have a monetary base, and I said earlier, we have these excess reserves. And that's only part of the liquidity in the entire economy, because not 100% of the liquidity and cash in America is controlled entirely by the Federal Reserve. In the old days, it was just the banks, the depositories. Now we have all these new instruments and new private equity groups and so on.
Okay, now
so the issue is that how do we control that going back to the economy?
Right.
Well, we can raise short-term rates, the interest we pay on these excess reserves. We can create other little mechanisms to do that, or ultimately, if we had to, we could buy back what we bought. So when we buy something, we pay for it. When you buy it back, no, then you're just taking money out of the system, right?
Okay, you brought me to another issue though, which is rates. We have to, before we break this, take this first break.
When we sell something, we could sell.
Okay.
But I think that would be the last resort here, because we have to be careful here. The markets have moved, according to us. You know the old saying, you don't fight the Fed. We have driven interest rates to
does the Fed fight the markets? That's the question.
Now markets are driving rates even lower. We're not buying anymore. But the point is, we have to be extremely careful. And if there is a sale of these instruments, we'd have to do it very slowly over time.
Quickly on rates, there are a number of substantial individuals like Warren Buffett, for example, Larry Summers, Jack Welch, all of whom have said recently it would be a mistake to raise rates while the dollar is as strong as it is. To which you say what?
Well, look, I think we deal with the real economy, and we have to worry about what's coming down the pike. If we see glimmers of inflation, which we don't see right now, the trim mean measurement, which the Dallas Fed had, which is the most accurate of all, is running between 1.6, 1.7% on a 12-month basis. If we were to see employment continue to increase, we're getting much, much better on that front, and you begin to see the wage price pressures, that should govern what we do with interest rates. They're thinking about their corporate earnings. I fully understand that. I'm worried about what's best for the citizens of the United States. And the real thing is, we don't want to rekindle inflation. We're not there, by the way. And you know I'm a hawk, but we're not there. But employment is getting better and better and better. And soon we'll reach a point where wages will start increasing, and they're gradually ratcheting up with each passing year now. You saw they came in about 2.1%. It's still not enough, but it can move very suddenly.
Will the Fed use the value of the dollar as one of the indicators which would determine whether or not it raises rates?
We don't determine the value of the dollar. Markets determine the value of the dollar. We don't intervene in that marketplace. But it does impact us in terms of one of the key variables, which is net exports. It affects how much we can sell abroad, how expensive it is. It also helps our consumers, by the way, because it's a lot cheaper. The way things are sourced these days from multiple sources, we're a consumption-driven society. 70% of our GDP comes from consumption. So there's a balance there. And I understand what they're saying.
Yeah. But you can't consume unless you produce, though. And
but they may be putting well, but I think it's important. They have global operations. It hurts their earnings.
Yeah.
I understand what they're saying. But there's some benefits to it as well. And the old formula you learn in high school economics, which is GDP, our production, our GNP, our output, is the sum of consumption plus investment plus government plus or minus net exports. So it'll dampen the export side, but there's some benefits that come also from a stronger dollar.
We just went through 6 minutes very quickly. We have to hold you on. Can you stay with us?
I'm sorry to use a formula, but it was a high school formula.
That's quite all right. Coming up.